Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. First week of February. Hope everyone had a enjoyable weekend. Hope everyone that is a fan enjoyed the Super Bowl. And going to get started this morning. I will mention Super Bowl. Last night, Kansas City Chiefs won. And from a stock market perspective, perhaps it's a coincidence. The stock market in the U.S. does worse when an AFC team wins. The Chiefs are an AFC team. And not including last night's when an AFC team had won the Super Bowl 26 times, so I think that makes 27. So it's been a 50-50 split between the AFC and the NFC. When the AFC wins, the market is up an average of 6.6%. When the NFC team wins, the market has been up an average of 10.5%. We'll see if that's coincidence or providence. So this morning, I'm going to get started, talk about a topic that is very relevant after the Tax Act that was passed going into the 2018 tax year, something we've talked about a couple of times in the past, but felt it was an excellent idea to revisit, and that is charitable giving. And want to discuss this morning charitable giving through a donor-advised fund. And this is something that investors or clients of some advisors can really revisit and consider, given the changes in the tax code. And I want to give a numerical example of possibly why a donor-advised fund could make lots of sense for someone who's contemplating a meaningful charitable contribution, and it even makes tremendously more sense if you've got a combination of appreciated securities or appreciated assets, doesn't necessarily have to be stocks or bonds, and the desire to make a charitable contribution. So as a way of an example, let's assume you have a client, you're an investor or the advisor, and you have a client who invested $10,000 into a stock in a non-qualified account. Could be Microsoft, could be Amazon, could be many stocks in this moment in time. And let's say a number of years ago your client or yourself was very smart and you invested $10,000 and it's grown to $100,000 and you think that the valuation is fairly rich at this point. But you don't want to sell because you're going to incur $90,000 in taxes. But you do plan on making a charitable gift this year, and you're thinking of giving money to one of your favorite charities. Perhaps it's $50,000, perhaps it's $25,000, and you have this appreciated stock. Well, one of the things that you can do is you could take that $10,000 stock that you purchased, and now is worth $100,000, and you can contribute it to a donor-advised fund. Now, if you weren't going to contribute it to a donor-advised fund, you would have a gain of $90,000 if you sold that stock. Let's assume you're in a 40% combined federal and state tax bracket, not that unreasonable, perhaps even on the low side. You'd have a $90,000 gain. You'd pay $36,000 in taxes in that example for selling that appreciated stock. And then what you would do is then you would take your $100,000 outside of that, and you'd make a gift to a charity, and you would get a write-off. In that case of $40,000 because you donated $100 in that example. You get a $40,000 write-off. You pay $36,000 in appreciated stock. Great news, you got a $4,000 less in income that you're going to report on your taxes because of the difference between the two. Alternatively, you can donate money to a donor-advised fund and give that appreciated stock to the donor-advised fund. In that case, you do not owe any taxes on the gift. So you take a $10,000 stock, you gift it for $100,000, and now you gift that $100,000 to charity. And in that case, instead of having a $4,000 tax benefit, you've got the full tax benefit of the charity, or a full $40,000 write-off, clearly significantly tax advantageous. It's for that reason that donor-advised funds have grown to be the most popular charitable giving vehicle in the United States, creating a simple, practical, and tax-effective means for donors to achieve their charitable wishes. We at Lantern work with the largest nonprofit donor-advised fund through our relationship with Pershing, and Schwab also has a relationship with the American Endowment Fund. There are others out there. It doesn't necessarily have to be the choice for you or for your clients. And how do these donor-advised funds work? Well, they basically work they rely upon the participation of the client and the investment professional with regards to, number one, the investments in the donor-advised fund, because you donate assets, and you don't have to gift all those assets all at once. So, for example, in the example we just gave, perhaps you donate all $100,000 to the donor-advised fund, all that appreciated stock, because you plan on making charitable contributions over the next 10 or 20 years. But in the short term, you have the immediate need to make a $25,000 gift. So you donate the $100,000 in stock, you gift the $25,000, you get the full $100,000 write-off at that time. Then the $75,000 gets invested by the investment professional, typically in a managed account, and then over time, hopefully that investment grows, and over time, through recommendations of the person who donated the fund to the donor-advised fund, they give out suggestions of or grants of where they want those funds to go for charitable purposes. What can you contribute to a donor-advised fund? You can contribute cash. The example we just gave is marketable securities. You can even donate life insurance policies, closely held stock, and real estate not subject to a mortgage. Note that the IRS does require donors to obtain at their own expense an independent qualified appraisal of contributed assets that are not cash or marketable securities. Upon the gifting of an asset and receipt, then in this case, the American Endowment Foundation would send the donor an acknowledgement letter containing all the information necessary to document the contribution for tax purposes. What do you do if you pass away and you don't get the opportunity to donate all those funds to charity? Perhaps that's your intention and you're looking to leave a legacy. In that case, you set up a successor advisor to the fund, and that person manages after you are no longer able to do so. Alternatively, you could provide instructions to donate all of the funds to specific charities upon the death of the person who made the contribution. So, something to really think about. It is the beginning of the year, something to think about of what you may want to do over the course of a year. And donor-advised funds do enable you to take that full deduction when you make that contribution, something that's also advantageous given the changes in the tax code and the changes to how the deductions work. So something to strongly consider if you are charitably inclined. So moving on to financial markets, changing gears here as we see the effects of the coronavirus permeating the market last week and continuing on into this morning. And financial markets certainly were very volatile at the end of last week as the Dow took the coronavirus seriously, dropped 733 points last week. 600 points alone on Friday, and things changed very quickly. The coronavirus was on people's minds, but it was not necessarily viewed as a threat here in the United States until Friday, when it started receiving news that it was spreading outside of China, and the markets decided that perhaps this is something we've got to be more concerned about. So, the chaos that ensued, perhaps there's some silver linings to it. One is that the stock market is no longer overbought. More than 80% of S&P 500 companies closed above their 50-day moving average on January 17th, On Friday, that number had dropped to 45%. At the same time, volatility, which had been hibernating, suddenly revived, where the VIX on Friday traded as high as 21.6, and hadn't seen that level in over 2 months. Good news is that the stock market has risen in the months after such spikes in volatility following long periods of calm. But that certainly doesn't mean the pain is over. The S&P is down just a little over 3% from its all-time high on January 17th. But it does mean that investors should start looking for a buying opportunity once the fears of coronavirus start to fade. So where are we looking this morning? Well, after last week, and at the end of last week, we saw the S&P for the week was down about 2.1%. The Dow down 2.5%. Nasdaq was down 1.75%. Foreign stocks were down 2.5% in emerging markets, and this is before the 8% decline that we have going on this morning in China after those markets were closed because the lunar holiday had kept the markets in China closed last week. So even before that, last week we saw a 5% dip in emerging markets. Year to date, ahead of the opening today, where we see some recovery at least at the outset. S&P was almost entirely flat for the year, basically zero return. The Dow down about 1%, the Nasdaq up 2% year to date, and foreign stocks down 2%, and emerging markets up 4%. Year to date, best performing sector are utilities, up just under 7%. Worst performing sector, energy, down 11%. 10-year Treasury, when we felt yields had gotten so low they just couldn't get any lower, or down to about a 151 last week, and year to date the 10-year Treasury up just over 3%. This morning we're seeing futures here in the U.S. up about 170 over fair value. S&P futures up about 20 over fair value. Nasdaq futures up about 68 over fair value. Mentioned the Shanghai closed down about 8%, just under 8%. Some of this recovery happening as China's central bank took steps to limit the impact of the deadly coronavirus, which has at the moment nearly halted the world's second largest economy. People's Bank of China announced several measures aimed at stabilizing the economy, and we're seeing the effects here in the U.S. of that, as well as the fact that at least the weekend is over, and the news flow, while was not necessarily great, perhaps people had envisioned even worse news coming out of China over the weekend with respect to the coronavirus. One of the other factors that might be impacting the markets, it's hard to tell, when you're doing the analysis, is perhaps what the markets fear in terms of who the Democratic presidential candidate will be. Today, the Iowa caucus is taking place, and then next week we have New Hampshire, then Nevada's on February 22nd, and South Carolina on February 29th. Super Tuesday's on March 3rd. Many suggesting that some market weakness may be because Bernie Sanders is rising in the polls, and market experts, at least in their opinion, feel that President Sanders would not be as market-friendly as a President Trump or a President Biden would be. So if it looks like Bernie is gaining traction, that's something that financial markets may be concerned about. In the commodity space, we are seeing oil relatively flat after a significant sell-off. OPEC is considering another 500,000 barrel cut. Oil highly dependent on the Chinese and their purchases of oil, and with that economy at a relative standstill, that's something that's weighing on oil in particular. Gold this morning relatively flat, and that's at about $15.80 an ounce. In news, the Chinese have accused the United States of whipping up a frenzy with respect to the coronavirus. Chinese saying the U.S. is whipping up panic over a fast-spreading coronavirus with travel restrictions and evacuations That is the Chinese position with respect to the coronavirus. Oracle in the news saying that they are adding cloud centers in 36 different locations in 5 countries. This morning. In Treasuries, yields a little bit higher this morning, but still very low. The 10-year is at a 154, the 30-year at 203, the 2-year is at a 135. Keep in mind that is below the yield on the Fed funds rate, which is 150 to 1.75%. In the news, the number of confirmed corona cases in China exceeded 17,000 today. Death count climbed above 350. Fitch affirmed Japan's A rating with a stable outlook this morning, and in some individual stocks to keep an eye on, we see strength this morning in Gilead. There's a report that China is going to be testing one of their vaccines to see if it's effective against the coronavirus. Company with symbol AIMT, Apple Ida Mary Tom, moving up this morning about 15%. The FDA approved the drug for the first treatment for patients with peanut allergies. Baidu and Baba rebounding a little bit this morning in China. And some analyst comments this morning. Verizon downgraded this morning. It's down about 0.5%. Companies that were upgraded include Nike and Seagate and Applied Materials as well. Apple down, at least as it was a few minutes ago, about 2 points after saying it will temporarily close its stores in China through February 9th. Moving on to what we have to look forward to this week, we've got the Iowa caucuses today getting underway. Today we also get the Institute for Supply Management Manufacturing Index to come in expected at 48.5. Tomorrow, President Trump is scheduled to deliver his State of the Union address to a joint session of Congress. We also get earnings tomorrow from Gilead, Simon Property Group, Ford, Walt Disney, tomorrow, just to name a few. Wednesday, we get the ADP employment report. We also get earnings from Merck, General Motors, Spotify, Peloton, Fox. Thursday, we get labor costs and productivity for the fourth quarter. We get earnings from Uber, Twitter, Bristol Myers, Activision, to name a few. And then Friday, we get the employment report for January. It's expected to show unemployment is held steady at 3.5%. Economy is expected to add 150,000 jobs. Average hourly earnings are expected to have increased 0.3%. A couple articles in Barron's, and I'll turn it over to Brad to talk some more about the markets. So taking a look at Barron's, Barron's ran a headline story talking about dividend-paying stocks and talking about the opportunities in dividend-paying stocks outside the United States. U.S. dividend yield on the S&P 500 is about 1.8%. The DAX in Germany has a yield of about 2.9%. The FTSE in the United Kingdom yields about 4.6%. Japanese Topix yields are about 2.3%. And if you look in the emerging markets, a country like Brazil, the Ibovespa has dividend yields of about 2.9%. And this is on top of the fact that many of these international markets trade at valuations that are lower than the U.S. S&P 500 trades about 18.5 times earnings after the sell-off versus about 14 times in Japan, 13 times in the U.K., and about 14 times in Brazil. And U.S. investors typically in the last 10 years after the strong run-up in U.S. markets have displayed a very strong home bias and have largely neglected international stocks. Matter of fact, a recent study by Vanguard where they looked at the clients of their personal advisor services found a significant home bias. 83% of those investors allocated 10% or less of their portfolios to international investments. These are typically clients who are doing it themselves, so it shows without that outside professional advice, perhaps even more of a bias to be U.S. centric. One of the reasons that U.S. stocks may pay lower dividend yields is that because U.S. companies tend to be much larger purchasers of stock. U.S. companies bought about $700 billion in stock back last year. This compares to, let's say, about $131 billion from the MSCI index. And this is somewhat due to the fact that U.S. CEOs are compensated based on stock price appreciation, and buybacks are viewed as more share price friendly as opposed to dividends, which provide that steady stream of income. So a couple of ideas in the dividend-paying space that Barron mentioned. In the international space, Novartis, symbol Nancy Victor Sam, they mentioned, yields about 3%. SK Telecom, which is a Korean wireless and wireline telecommunications company, symbol is Sam King Mary. SK Telecom yields about 4.4%. China Mobile, largest telecommunications company in China, symbol Charlie Hotel Lucky, yielding 4.3%. Takeda Pharmaceuticals, Japanese pharmaceutical company, symbol Tom Apple King, yielding 4.2%, to name a few. For investors who are reluctant to pick individual stocks or even regions, article mentioned one option is the Vanguard International High Dividend Yield Fund, ETF fund, that is. The symbol is Victor Yankee Mary Ida, recently yielding 4.12%. Mutual fund in China, obviously, there it's not certain what's going to happen in the near term, but the Matthews China Dividend Fund, symbol is Mary Charlie Delta Fox X-ray. That fund's trailing dividend yield was about 3.5%. Mentioning an individual stock, Barron's spoke favorably about Viacom CBS, symbol is Victor Ida Apple Charles. Talked about that they have a new addition to their streaming platform that is attracting new subscribers, and that is Picard, which is a Star Trek series. And Barron suggesting that this offering could help Viacom CBS hold its ground as it fights a galaxy of rivals in the streaming wars. We all know who those competitors are. Imperial Capital, quoted in this article, mentioning Viacom CBS as their top pick within the media and entertainment sector, $59 target. The stock closed at $34.13. The analyst also mentions that Viacom CBS has other original content as well, shows like Twilight Zone, The Good Fight, Strange Angel, Tell Me a Story. Also interesting is that CBS has a library of about 8,500 series, including Survivor, NCIS, The Young and the Restless, Big Brother, 2.5 Men, SEAL Team, Taxi, Young Sheldon. Put that in perspective, that library is about 8,500 shows. Netflix's library is about 5,800 shows, and Netflix's library is coming under pressure as companies such as Disney pull content from Netflix. Also, an additional differentiator is sports. For $5.99 a month, Viacom CBS viewers can watch live sports, including the NFL, PGA, NCAA tournament, SEC football. And CBS this year also has broadcasting rights to many of the games in the NCAA tournament. CBS Viacom is expected to earn about $6.23 a share on $30 billion in revenue. The analyst in this article said he also believes 2020 will be a record year for advertising at CBS, and this is despite the ongoing pressure in the industry and concerns that advertising in television is under secular pressure. Viacom CBS on their all-access service has 10 million subscribers, and they expect, at least this analyst expects them to hit 25 million subscribers for all-access and Showtime's OTT by 2022. Talk a little bit about the bond market, then turn it over to Brad. For those looking for yield, it is difficult to find here in this low interest rate environment. Although again, the U.S. Relative to the rest of the world, despite yields looking fairly meager and looking less rich than they were just a few weeks ago, nevertheless still higher than a lot of the rest of the world. And Barron's discussing that CDs right now offer better yields than many bonds. I discovered that last week when I was doing some homework for a couple of clients of the firm here. So we're in this unusual situation where individual investors have access to better financial products than large institutions. Perhaps it's a temporary anomaly in the rate setting for CDs. But right now, you're looking at 10-year Treasury yields of around 150. You're looking at 1-year T-bills in the neighborhood of 145, and you're looking at the availability of 1-year CDs in the neighborhood of 160 to 170. 3-year CDs around 170 versus about a 135 in the Treasury market. And when you look at the real short-term tax-free rates, they're also even on a pre-tax basis not competitive with CDs at this point. So something that might be worth taking a look at is yields in CDs if you've got an income-oriented client. Speaking about municipals, the Bloomberg brief, which highlights the fact that muni stockpiles are near a 5-year low. The first story in the article says municipal bonds are flying off the shelves at Wall Street banks. Securities dealers have their lowest dollar amount of municipal securities in inventory since 2014. A managing director at Neuberger and Berman quoted in this article says it seems like buyers are just taking down inventory hand over fist. What's one of the reasons for this is that investors, when they are seeing these very low yields on individual bonds, are choosing to hand money over to mutual funds, where oftentimes they see a higher distribution rate. Doesn't necessarily mean that their returns are higher, but sometimes investors seduced by the distribution rate in mutual funds, not necessarily fully understanding what it is that they're purchasing, but nevertheless, that's where the flows are going. $1.8 billion added to municipal funds last week, and this is an environment, as we discussed last week, and Brad has highlighted, where municipal supply is very low relative to the number of bonds being called, relative to the number of interest payments that are occurring, and relative to the amount of money that's flowing in. Real mismatch between supply and demand right now in the municipal space. That's everything I've got. I'm going to turn it over to Brad to give us some more insights this morning. Good morning, Brad.
Morning, Keith. Thanks. Good morning, everyone. Hope everyone had a great weekend, enjoyed the Super Bowl. Really just always a fun time. And Monday's always, after the Super Bowl, a real letdown. But it's a great game, and welcome back. Just a couple of my personal herd on the street comments. Last week I mentioned that I was at a cocktail party and that non-investment professionals were talking to me about all the money that they had made in the stock market. And I had mentioned that on the call. I regretted mentioning a little bit because I don't want to say that that's really that means anything. But many times it really is a telltale sign of a possible ensuing correction, and you never know what that correction is going to be. You don't know if it's a virus, politics, anything, but you just always have to keep your eyes open. This weekend's story was I have a very good friend who's a very successful momentum stock trader, and his comment to me was he likened the market to a blackjack table. He said, we just played a really good deck. We had the hottest dealer, but the casino just changed the dealer. And doesn't know if the dealer's good or bad, but he's really rethinking about what his next bet is going to be and how he's going to play the upcoming hands. And I think that was a very good piece of advice. Don't rush into anything. Think a little bit before you make big investment decisions. Now, on to what I do know about. As Keith had mentioned, the municipal supply has really diminished, and because of that, I really have bulked up our firm's inventory on high-grade municipal bonds. The reason I did that, even though I think that the absolute rate of returns are still paltry. There is a lot of demand, and people are buying these bonds. What I'm finding now is that the funds are getting very proud, and they are starting to reach for yield. And as usual, they've been reaching for yield for a year, and now I find that so many retail investors are following this. Very dangerous place to be when you're reaching for yield in municipals, as a lot of us realized in Puerto Rico and more recently Illinois and Chicago. As for Puerto Rico just had a ruling, and I'm sure that this will be challenged, but the pensioners are going to be giving priority over the pension bondholders. So Puerto Rico pension bonds have traded way down to pennies on the dollar. It is allowed for other Puerto Rico bonds, this is just my theory, to trade higher on that news. That being said, I don't trust any of them. Illinois also is on the move higher. They are seeking to raise taxes, and they brought a new issue to market. It's still real gambling money. I think that they're selling at yields that are so low relative to the risk that one's taking on to buy these bonds that my op-ed is that I'm still a seller of Puerto Rico and Chicago and Illinois bonds. Historically, something has to give. Either the bond market's going to give or the stock market's going to give. In November and December 2018, both markets gave, and because of this, you just really need to think about where you want to be positioned when this potentially happens. And I really don't know if it's stock market's going to give or the bond market, but something will. What I love about municipals is that if the bond market happens to be the one that gives, it's very easy to harvest the losses in municipal bonds when you're investing in high-grade bonds. And that's all I have for today.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.